Michael Burry has just put all his money into the worst financial disaster in history. We've spent time investigating Burry to figure out his intricate financial technique. Burry made hundreds of millions of dollars throughout the dot-com boom and the 2008 collapse. Now he feels he can make billions in the coming months. You may easily uncover Michael Burry's disclosed holdings if you search for his portfolio online. That's precisely what Burry wants you to see. He owns 11 equities worth a total of $165 million, as well as options contracts totaling approximately $3 million. Burry's entire public holdings are approximately $168 million, but he oversees $291 million, according to his Form ADV. So where did he put the other $123 million? Hey, welcome to Stock Market Mate. Today, we'll explain exactly how Burry just went all in on the incoming market crash. Before we get into Burry's confidential holdings, we must talk about his publicly disclosed stocks and options. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, let's get right into it. The 13F filing. Michael Burry manages Scion Asset Management, a hedge fund that must disclose its assets through 13F reports every quarter. The Securities and Exchange Commission uses this form to disclose institutional stock and option ownership. Every institutional fund manager with at least $100 million in assets is required to file a 13F filing. Michael Burry oversees approximately $300 million, hence he's required by law to file a 13F form. Burry owns 11 distinct stocks and one put option, according to page 3 of his most recent 13F filing. These are all bets on his short-term macroeconomic premise. Burry anticipates that inflation will continue to accelerate in a cyclical manner, with prices spiraling upwards. He identified equities that will benefit as inflation escalates over the next 5 years, based on his inflation thesis. Burry's assets. Input costs are a crucial element during inflation. Input costs are expenses incurred during the production of a product or service. Labor, materials, fuel, structures, and equipment are some examples. If prices rise, so will input expenses, resulting in smaller profit margins. For example, airlines are currently struggling with two main input costs: increased fuel prices and pay increases. Airlines have raised ticket costs, but because inflation is continually increasing, plane tickets must also climb. Higher ticket prices will restrict customer activity, resulting in less profitability for airlines. Michael Burry understands the significance of input costs during inflationary periods. He owns 11 stocks totaling $164.8 million with a common theme. These assets fall under 4 categories: travel, technology, healthcare, and value. Burry's 2 holdings in the travel industry will gain greatly from rising oil prices. Booking Holdings, for example, is an internet booking company that makes a set of commissions on bookings. Booking Holdings' profit will climb as ticket prices rise. The second holding, Ovintiv, owns Encana, a natural gas extraction firm. This means that if gas prices rise, Ovintiv's profits will climb as well. Michael Burry also owns technology stocks with low to no input expenses. Google and Meta are virtually entirely based on the internet, which necessitates minimal material expenditures. His holdings in the healthcare sector have the opportunity to boost prices due to their considerable pricing power. Cigna and Bristol Myers Squibb both have agreements and patents that give them a significant market share. Finally, Burry owns value equities that are trading at a significant discount to their true value. Stock values have less room to fall because they are already trading below their true value. Despite the fact that we divided Burry's holdings into 4 groups, the majority of the companies have relatively similar features. Almost all of them have extraordinarily high profit margins, significant competitive advantages, great pricing power, massive cash reserves, and low valuations. The most essential of these characteristics is pricing power. Pricing power, according to Warren Buffett, is the most crucial feature of any organization, especially during inflationary periods. Having pricing power assures that businesses will continue to make money when inflation rises. Michael Burry's bet against Apple. Burry also has put options on Apple. Put options are agreements to sell 100 shares of stock at a predetermined price. Assume there is a put option in Google stock with a strike price of $3,000 and an expiration date of July 13, 2023. This put option allows the owner to sell 100 shares of Google for $3,000 by July 13, 2023. Burry has option contracts to sell 206,000 Apple shares, but we have no idea when they will expire or how much they will cost. We may safely estimate the contract price at around $15 per contract based on current option pricing. So far, we've gone over Burry's reported positions, which are worth an estimated $168 million. But, having stated that, where is the remaining $123 million in Burry's management? We were able to determine where Burry is betting his remaining funds by applying the process of elimination. There are 6 places where Burry could be investing the remaining funds. He could be holding cash, betting on Forex Exchange, purchasing commodities and farmland, shorting stocks, shorting crypto, or betting against bonds. The reason why I listed these options is that they do not have to be disclosed to the public through SEC filings. The options I listed are basically the only places where Burry could be investing his funds. Forex Exchange. We can rule out cash because Burry anticipates it to lose value at an alarming rate. So what about the Forex market? The Forex Exchange is a global market for exchanging government-backed currencies, commonly known as fiat currencies. Forex trading entails betting on which fiat currencies will outperform others. For example, by trading the dollar for the yuan, investors may bet on the Chinese yuan outperforming the USD. If the yuan appreciates in value, investors will be able to exchange it for dollars. While the dollar is rapidly weakening, it has performed well on the Forex market. This is due to the other countries printing more money than the United States. Farmland or commodities. Burry's next choice is to buy farmland or commodities such as gold or silver. We know that commodities and farms have historically been a good inflation hedge, but only when inflation is moderate. During hyperinflation, governments often aim to keep their currency's value stable to avoid a revolt. Because a loss in the value of a currency puts the government in a vulnerable position, the government often taxes or confiscates assets that are performing well to preserve the currency's worth. Shorting stocks. Burry's next option is to sell stocks. Burry is most likely shorting speculative stocks because he believes stock prices will drop. Michael Burry plainly believes that equities will fall precipitously in the short term, so it is reasonable to presume that he is shorting stocks. He previously possessed Tesla put options before selling them in October 2021. The signs lead to him potentially switching to outright shorting rather than putting options. This is because options premiums have become too expensive. Shorting cryptocurrencies. Burry's 5th option is to short cryptocurrencies. Because cryptocurrencies are speculative, he's pessimistic about them. Burry has considered shorting cryptocurrency in the past but has opted against it. Burry claimed in an email to CNBC in late 2021, "I've not been shorting cryptocurrencies at all. We feel that cryptocurrencies are in a bubble and that the majority of those involved do not comprehend it properly." This eliminates the potential of shorting cryptocurrency. Shorting bonds. Burry's final option would be to short bonds. Burry's largest bet is expected to be shorting 30-year government bonds. So what makes Burry want to sell 30-year bonds? The 30-year Treasury bond yield is now about 3%, implying that bondholders will earn 3% per year if they hold their bonds for the whole 30 years. Bond yields and bond prices are inversely connected. Therefore, a rise in bond yields leads to a decrease in bond prices. In general, rising interest rates have a greater impact on long-term bonds. As interest rates rise, the price of a 10-year bond will decline far more than the price of a 6-month bond. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!